Hello and welcome to all Daily Hunt viewers to this very special series that we've put together for you. It's called The Money View from the Top. And we are kickstarting it with no other than Balasubramanian, who is a veteran of the Indian mutual fund industry. He's the current AMFI chairman. He has been AMFI chairman before as well. He's also the managing director and CEO at Aditya Birla Sunlife Asset Management. Thank you very much, Bala. It's always a pleasure talking to you. And a very warm welcome to you on behalf of all Daily Hunt viewers, millions of them tuning in to watch and hear your thoughts on a lot of issues which are troubling investors. Had we spoken a month ago, perhaps the questions would have been very different. But let me come straight to the point. Inflation, both in India and globally, and the interest rate hikes in India, the beginning of it. How are you seeing this? Is there going to be a lot more pain coming ahead? What could be the implications of this, and what should investors keep in mind?
Thanks, Vivek, for having me part of the show. I think clearly, if you look at last 4-5 months, as you rightly put it, the global uncertainty has become quite severe, mainly on the back of what we saw in Ukraine-Russia war, and we have seen commodity prices skyrocketing and touching all-time high. While it has benefited most of the companies who are operating in the space, definitely the thing is led to an increase in the increase in prices, therefore have an impact on inflation. Second, we have seen in general energy prices going up globally because of the Ukraine-Russia related issues. They also have its own impact on the inflation prices. Therefore, the policymakers, otherwise they were more clear about the unwinding process post-pandemic that they did over a period of next 2 years. I think they have to undertake the unwinding process much ahead of time, given the fact that inflation is something is hurting. My own belief is you'll probably see 1 or 2 more hike, but a little sharper. Then after it'll get moderated, given the fact that very high interest rates also will have an impact on growth. I think for global nations, for most of the global central bankers, getting back on growth, while of course addressing the concern of inflation, is also equally important. Therefore, after a few rate hikes, we will see, I think, get moderated in terms of rate hike cycle. That is the time, I think, by the time I would assume the commodity prices remaining high currently because of the war kind of situations may also get settled down. And therefore, inflation will start dropping it, and then the focus will come back on growth. From investors' point of view, this cycle we always go through every now and then. Every 4-5 years, we go through the cycle. Therefore, from investors' point of view, I think there's no question of getting scared on this. And given the fact that ultimately I'm making investment for long term and use this uncertain period for building portfolio rather than staying in the fence and waiting for confirmation to come for investment, which will never come. Even history never comes that kind of confirmation, never come for investors to take a call on investing.
Bala, in your younger years, you tracked the debt markets very, very closely. Personally, I mean, you still track them. But, when an interest rate hike cycle begins, what kind of an impact does that have on a debt mutual fund investor? Because it's taken a lot of effort to try and tell investors, retail investors, I'm not talking about corporates here, but to tell retail investors that debt is as important as equity in your portfolio. What could be the impact? What should they look out for now that the rate hike cycle, so to speak, seems to have begun in India?
Correct. So I think definitely the debt market, as the yield starts moving up, definitely I think that becomes an alternate investment which investors can consider. I think the way debt investment has to be looked at is the one real rate of interest in the debt, and second is the earnings yield versus the bond yields, which again another reflection that one can look at between equity allocation versus the bond allocation. And also given the fact that today the 10-year bond yield comes close to about 7.5 in that range, and naturally the payoff I think is much better from investors' point of view. While we make an assumption the interest rates will move up further, I think our portfolio yields will getting higher and higher I think that makes it better for the investors as a whole. But having said that, clearly again, the conservative investors who actually won't park their money in fixed deposits, which again rates are not very attractive at this point of time, then naturally the bond is going up, could become potentially a good opportunity. Again, there are funds in the fixed income scales can be captured out of that, can be actually taken out of that for investment point of view. But having said that, the hybrid funds such as balance advantage fund or the equity savings funds also have got a reasonably good portion of the portfolio invested in fixed income, and some portion of the portfolio comes in equity. So conservative investors can also choose this, given the fact that today investing in a 5% yield or 6%, I'll be investing in a higher yield. As the interest rate goes up, then naturally the tilt towards payoff will tilt towards the fixed income will get better. Again, that's a cycle which you go through. Therefore, fixed income can be actually come part of the asset allocation, absolutely no doubt. But if you are building the portfolio for the longer term, for wealth creation purpose, then equity will remain a reasonably good component of that. At the same time, the fixed income portion, as it is in the industry, there is a new evolution that is happening in terms of target return fund kind of model that already start coming in. I will see in the next 2-3 months, but funds like the traditional income fund. When I started my career in Birla mutual fund, they had launched the first income fund in the country, the Birla Income Plus. They got about 26 years of track record. All such funds probably could also revive. And given the fact the yields are relatively better than what we normally get in the fixed income side.
Bala, how do you explain the pullout by the foreign portfolio investors? I mean, that happened much before the Ukraine-Russia war. They've been continuously taking money out. It's a few lakh crore, I think, over the last couple of years. When do you see that stopping? I know that domestic investors like you, institutions, have been able to cushion the impact. If 10 years ago the same kind of exit would have happened, we would have been at a very different Sensex level. But there seems to be now the domestic institutions also tiring to be able to match the kind of outflow that FPIs are doing. When do you see that changing, and what, according to you, are the reasons why this is happening?
I think FI's outflows largely to do with the relative opportunity that they see in the global market. That's one. And second is the risk of trade or risk appetite that they have, especially in a rising interest rate scenario. If there is a narrowing of gap, the interest rates, then actually that makes them actually go back to the developed market rather than coming to the emerging market. That's one. Second is a lot of investors who have been putting money in global markets. They do either leverage trade, and therefore they bring in money through the bank's borrowings or maybe the leverage trade that they do. That's where the money comes in. And times like today, where the currency could become volatile, inflation remain high, interest rates will go up, and then the macro, the current account deficit, a balance of payment could go for a change. And keeping all this in mind, generally emerging market and these kind of scenarios, emerging market take the brunt of this kind of global uncertainty, and they generally prefer to go to a destination. If the US bond is gives me about 3%, and people also prefer to actually go on and stay there at 3% rather than taking a risk in the emerging market. This is normally the trend that we normally witness whenever global uncertainty emerges. So at this point of time, what we have seen in India is purely the reduction of equity flows in global market, and India being one of the largest recipients of emerging market flows, then naturally when they turn negative, we'll continue to see same outflow also happening the way as the inflow comes. But fortunately, the Indian mutual funds and domestic institutional investors have become the large player. The last few years, we have been the strong counter force for FIs outflows in India. And third, of course, is the interest rates in India. Though the policy rates will go up, though the bond yields as per the govies will go up, deposit rates looks unlikely it is likely to go up, given the fact that there is no demand for credit. Therefore, the banks are not going to be in a hurry to raise interest rates. Therefore, from the investor's point of view, naturally they have to look at equity as another investment opportunities, so like SIPs and STPs, and invest for long term. And there is a model I think will emerge. So therefore, domestic institutions will continue to remain strong counter force. But my own belief is, the moment reach certain level and the valuation now that become somewhat at the reasonable good level. I think supported with good monsoon, or let us assuming a scenario, the next few months things get better, both on the global scenarios, inflation front, as well as the policymakers suddenly saying now we'll wait for some time for the rate to be hiked. Then naturally emerging market flows will increase quite significantly. And I see that happening this year, second half this year. There's high probability the FIs who are remain seller would probably turn a buyer in India.
Bala, you travel a lot, you meet a lot of investors on the ground. Don't you feel in the last couple of weeks or maybe more, there seems to be an illness that is setting in? The sentiment is no longer that bullish as it used to be. While on the one hand we're seeing, on the other hand, actually, dealing with inflation on a very basic level. Do you feel that the sentiment has somewhat turned? And what I hear you say is that probably things will get better from the second half of this year?
I think the sentiment, if I travel at the ground level, I just traveled the entire Mumbai market. I just covered about 3 days back. About 2 weeks back. And then I covered some parts of Maharashtra. I think ground level acceptance of investing in equity is only growing. The mood in terms of investing for long term remains bullish. At the same time, the investment that has been made in the last 1 year or 2 years probably may not be making money. To the extent, yes, the recent money that has come into the market have not made any money for them, given the fact that the market has corrected very sharply. Second is the kind of crash that have been seen in NASDAQ. I think quite sharp in terms of correction. Even India also, if you look at some of the sectors, which has been a great sector performing very well, also have gone through some uncertain period. Therefore, to the extent the portfolio impact, no doubt, because at the end of the day, nobody would like to see a negative growth with respect to the portfolio valuation. To the extent, yes, the feeling could be there. If it is more than anything else, the bigger pain point has come actually for those investors who have gone into the equity market directly. In the last 1 year, the number of investors who have gone to the equity market, the number of people actually have got complete different experience than what you have seen in 2020. At 2020, people thought that 2021, people thought money making is easy. Everyone started playing in the market directly, either buying direct equity or through the F&O market to leverage. Suddenly they are saying that the value is disappearing, margin calls are coming. Then they realize, oh, I don't have more money to give. The best thing what they can do is square off from the market and then run away from the market. I think you'll see that realization has come in the last 3 months, 4 months of fall. More than mutual funds, I think it has given a huge negative impact on those investors who come in direct equity. Either the first-time investors or the old investors never tried their luck in the equity market directly, like HNIs, also have realized how market can be punishing you in case not having a discipline investing. In the contrary, on the basis of this, I see on the mutual fund side, at least mutual fund portfolios have fallen, no doubt, through this period. Because of the diverse nature of the portfolio, there has not been a significant, huge impact on single stocks or single sectors. Impact is not there. That's something I see as a realization has come. In fact, some of the advisors whom I met while I traveling, some of the advisors interestingly told me, some of the people who are not taking their advice are consulting them. And now they started coming back, showing their portfolio, what should I do in my portfolio? Therefore, for everything, there is an element of plus and minuses.
Let's talk about I mean, we've seen record numbers month on month. Of course, last month there was a slight dip, but 12,000 crores is what we've hit. And yet, it's a little dated, but maybe you have some fresh data that says that less than 10% of the SIP accounts are held for even 5 years or more. Is there a change? Is data in front of you showing a change, some maturity, or is it just, getting into a scheme, churning, getting out, and then ending up not making well?
Of SAP that we have to look at it. When I present our own number to the market, I don't get the industry number. When I look at our own number, 80% of the SAP book that we have is signed up for more than 5 years. And almost 75% of signed up for more than 3 years. Long period. that something will be remain. I think people already do a perpetual SIP knowing very well, no investment SIP is made for 1 or 2 years period. But having said that, market volatility makes people actually to stop the SIP and then come back whenever the market stabilizes. There is one set of investors are there, but there are majority of investors actually they hold on to the investment for long term. Therefore, that is actually a large component of them staying invested long term. Second is the people who come through the platforms like digital platform. They all come the small ticket size, 1,000 rupees, 1,500 rupees. The tendency to actually come for SIP for sign up for 5 years or 3 years, but the tendency to give up at the end of 3 years, looking at the market volatility, also equally prevalent. I think this has to, of course, one has to look at how far it behaves. I think one of the things that remains got established, SIP as a trend on a month-on-month basis is showing only uptick. So we'll probably see some consolidation in the next 1 or 2 months. Having seen from 9,000 bucket to 12,000, it moved from 9,000 to crossing 10, then 10 to 11, now 11 to 12. Will probably the whole post which changed from 12 to 13. Even if it come below 12,000 temporarily for some times, I think the trend is actually going towards 13, not towards say 10. So that's the model under which I think SIPs are generally getting built. Therefore, the volatility that may probably what you see may lead to a reduction. I'm not saying no, but at the same time, I think the growth path is on the positive side.
It is in times like this, Bala, that asset allocation becomes so important. People like you have been talking about it for more than 2.5 decades, but yet practically we all think that minute there is a momentum in a particular asset class, let's just jump onto it. We become greedy. We saw a very sharp fall when COVID happened. We saw an equally spectacular bounce back, taking us all the way to 62,000 plus. But how important is asset allocation, if you could explain to our viewers here?
See, asset allocation is something, whether it is a bull market or bear market, asset allocation is ultimately makes investors to make a portfolio which delivers better than any fixed deposit kind of investment. At the same time, helps in beating the inflation for the long term and create wealth as well as the steady income. I think the way asset allocation, my own belief is it happens. One, of course, for every investors, there has to be a component of equity, which I think is the wealth created. There has to be a component of fixed income, which again is gives a regular income generator. There has to be a component of emergency funding. Every individuals may not have all surplus all the time. Therefore, they have to also create emergency funding kind of thing, like put in liquid fund, which comes in handy when everything doesn't come in handy for you. So that's the model I think we build. The investors' needs of savings, investors' needs of regular income, investors' needs of wealth creation, investor needs of tax planning. All the things, all the 4 get covered under the asset allocations. I think that's something is the key. Second is, I think taking exposure into each of these category, equity category, and taking exposure is one model. By way of some percentage in terms of allocation, somewhere around 50 to 60% in equity. Then balance comes to the hybrid funds and debt funds. At the same time, nowadays, money managers also start running asset allocation fund in the name of more conservative asset allocation strategy, moderate and aggressive. I think some of these, the asset allocation fund or multi-cap fund kind of model where the money manager takes a call, how to increase the exposure to equity, when to increase the exposure to equity, and what component should be for forming part of the equity, taking it up on market outlook. And the same call will also be taken in the case of fixed income. So dynamically change your portfolio. In fact, if you ask me in the balance advantage fund, exactly serves the same purpose. Therefore, from the customer point of investor's point of view, either by do it by yourself in allocating between equity and debt and liquid funds, or you do allocation through the money managers through the asset allocation funds. They're all now it's available. That's the way I think one can look at the asset allocation. But at the end of the day, anything that is overexposed will have an impact. Anything which is underinvested has an impact. So I think these two are common. As long as one is able to address this through the asset allocation model, and that discipline once set in will probably give a better result from the investor's point of view.
My final question, Bala, you are the person under whose chairmanship Mutual Fund Sahi Hai campaign was launched. Earlier, you used to compete as an industry maybe with ULIPs. As you mentioned earlier, there have been millions of direct trading accounts which have been opened by young people. Again, there are millions of crypto accounts being opened by young people. How do you see the mutual fund industry continuing to project itself as, the right choice for people to be able to invest in equity, debt, gold, etc., etc.?
I think I still remember when it was created as a collective wisdom of the mutual fund members, committee members, comprising of my one other industry colleagues. When we rolled out that, we're all excited that industry will probably now start expanding. That point of time, we never imagined it will go beyond 25 lakh crore size at a short interval. I think since the time we launched, the folio counts have gone up by almost about 12 times for the industry. Assets have gone up by almost about 5-6 times, both in fixed income and equity. I think that's the kind of power which is there from the savers point of view. I think the more the awareness, when the investors start understanding mutual fund is a vehicle, is meant for the long-term investing, not for short-term. That's something is being established under the mutual fund messaging that we have been giving. Second is also now used for the purpose of improving the learning curve of the customers. Don't just look only at the return, you also look at the risk management practices and other facilities that is available in the mutual fund, which can serve the longer term purpose, also now being advocated. Now, having seen this, I would only assume this will only further gain more strength as you move forward, given the fact entrepreneurship industry is high. The people who have to beat the inflation and still generate wealth for the long term is still high. And the aspiration levels for the country as a whole will keep rising. And with all the combinations we put together, mutual fund only continue to grow despite all the volatility. Sometimes some industry will go through some challenging times. Despite all the things, industry will continue to grow given the fact this has now become a vehicle for every investor to consider without any doubt. That's something that got established in the mind of people.
Thank you very much, Bala, for joining us here on Daily Hunt. It's always a pleasure talking to you. Thank you for sharing your views and your learnings with our viewers. That's all we have in this edition of the show. Thank you very much. We'll be back with many more Face Money View from the Top.